High inflation and corresponding hike in interest rates to tame it by central banks in developed economies, especially in the U.S., have largely affected the cost of borrowing by emerging economies in sub-Saharan Africa. Patrick Huron, senior economist at Talima, joins us to review how these currencies have fared this year and what to expect going into the new year. Hi, Patrick. It's good to have you on the program.
Hi, well, good to be here.
Now, Patrick, if we cast a look back, how much of a blow have these currencies and most major economies in sub-Saharan Africa, how much of a blow have they taken this year?
The dollar is up about 7% year to date versus a basket of developed market currencies, whereas emerging market currencies, including those in sub-Saharan Africa, have actually held up a bit better and on average are down about 5% year to date. This is partly because emerging market central banks were more proactive in hiking their policy rates over the past 2 years. But aggressive rate hikes by the Fed over the past few months especially have started to erode that interest rate differential. And there's wide variation within the emerging market and sub-Saharan Africa currency universe. The Egyptian pound and Ghanaian cedi are both down about 36.5% year to date, so they're leading the way in terms of currency depreciation. And then the Kenyan shilling, South African rand, Ethiopian birr, Zambian kwacha are all down about 7 to 8%. Whereas more liquid currencies in East Africa, especially like the Rwandan franc, Ugandan shilling, are down just 3 to 4%, and the Tanzanian shilling and Mozambique metical are essentially flat so far this year. However, some of the stability in certain countries can be explained by currency management by the central bank, with sharp depreciations occurring instead in the parallel market. Nigeria is an example of this with a parallel market premium of about 60%. And likewise in Ethiopia, the exchange rate is trading at about a 90% premium on the parallel market.
So, looking at the downtrend you just talked about now, the flattish close for most of these currencies or currently trading at the moment, are we likely to see default in debt payments next year as a result of this?
Currency depreciation makes it more expensive to service FX-denominated debt, which is a large portion of the total public debt stock in many countries in sub-Saharan Africa. However, I think the bigger factor at play here is the tightening of global financial conditions, with the Fed's rate hikes pushing up the risk-free rate over the past year and spreads widening by quite a bit in many emerging markets. We count that yields are now above 10% and over a quarter of the emerging market index, which is typically a sign of distress in that market access has been lost. Countries without market access and with large external financing needs in the coming year will really struggle to avoid a debt and balance of payments crisis. We've already seen distress in Ghana, which announced plans to restructure its domestic and external debt this month. Other countries like Egypt and Kenya have managed to buy themselves some time by securing an IMF program and committing to difficult reforms, but risk will certainly remain elevated over the coming year. Countries at the greatest risk of default, we think, include El Salvador, Ethiopia, the Maldives, Pakistan, and Tunisia.
So is there recovery in sight for these economies, most of which you've mentioned, Nigeria? What policy changes would you recommend?
If the Fed reaches the end of its tightening cycle, as markets are currently expecting in 2023, then financial conditions could begin to ease for many distressed emerging markets, including those in sub-Saharan Africa, and the dollar could continue the weakening trend we've seen over the past couple months. However, there is still a risk that markets are pricing in an overly dovish rate path for the Fed over the next year and that they'll have to adjust their expectations upwards, especially if inflation proves stickier than expected. In the meantime, countries on the verge of distress will need to make difficult policy decisions to avoid a crisis, including tightening their fiscal policy and recommitting to pro-growth structural reforms that have largely taken a backseat post-pandemic. Many countries may also need to adopt a more flexible exchange rate and allow currency depreciation to improve their balance of payments and ease FX shortages, including countries like Nigeria, Egypt, and Kenya, where the currency has been held at artificially strong levels.
So, Matt, so what you're proposing is that there has to be stringent policy changes by central banks. And would you think that resorting to an IMF loan is a solution right now for most of these economies?
It's certainly one part of the policy toolkit that many countries have and should continue to consider. Like I said, countries that don't have access to the market will need to rely on alternative financing sources to plug that gap over the coming year. That can include support from bilateral partners or other donor countries. And where that's not sufficient, a lot of the time that will require IMF support to plug that financing gap and help serve as a backstop for some of these politically difficult reform efforts.
Thanks so much, Patrick Curran, senior economist at Telema, for joining us and sharing your perspective on the program.
Thanks, Will.